Change your mind, change your money, change your life. I am Coach Rob Lee Simmons, the host of this podcast, and let me be your tour guide to greatness. If I was doing any better, I would be you. And welcome back to the Greatness Academy podcast. I am here with my main man, DJ Patterson. He is a financial professional. He's a senior marketing director at Pinnacle Elite, and he is a financial expert, man. And I really brought him in because he has a wealth of knowledge that I want him to share with the people. And honestly, I'm about to pick his brain. So this is going to be a good one. DJ, welcome to the show, man.
Hey man, thanks for having me on. Glad to be here. It's beautiful weather outside, so it's a good day.
Hey, ain't nothing wrong with that, man. So DJ, he's in Nashville, Tennessee, and I'm here in Virginia. So we're doing this thing a little bit virtual. So the weather's a little bit different on my end. Let me get into. I like to get into the business. I don't want to waste no time, man. So tell me, financial services. How did you get into financial services?
It's a great question. So I've been in the industry now for 10 years. I used to kind of play around in stocks and stuff when I was younger, fresh in college with my dad. We and him would get different newspapers and magazines and figure out the Oxford stuff that they would send out, trying to figure out, where you're supposed to put your money, where you're supposed to put your money. And I gave him some money. We worked on some things. I never made any money with it. Right. I think I had my money in the stocks with my dad for probably about 5 or 6 years, put in 1,500. By the end of the 5 or 6 years, I had $2,000
Oh
or whatever.
Lord.
I'm like, all right, my goal was to be a millionaire by 23, 24, 25. This ain't it right here. Maybe we need to do something differently. And so my previous career wasn't dealing with financial things. My passion is working with animals. So that's what I thought I really wanted to do. But after working in that industry, I just realized that there's really no money in the animal world. And so I moved back to Tennessee and I started to look at other industries, and I was like, you know what? I remember me and my dad, we used to work a little bit on stocks, and I remember, I'm good at math. So let me see if there's something in that industry that I can actually fall in love with and be a part of. And that's kind of how I ended up finding financial services. I went in and I sat down with a company, and when I sat down with them, I learned more in 30 minutes than I had learned my whole college and high school career combined. And then when I saw what this industry pays, I was like, okay, if they'll take a guy like me and they'll train me from the ground up, then I'm going to do whatever I can to make sure that I make an impact with this company and I can stick around for years to come.
No, that's dope, man. And I love it because I caught the wave a little bit late. I know we talk about it now 9 years late, where I'm at now. But I'm here nevertheless, right?
Right.
I learned a lot of things from you. One of the things that I thoroughly enjoy about working with you is your passion. So can you tell me like really what is your passion when you work with clients? What does that do for you? As be able to help people? What does that do for you?
Right. So my passion honestly came probably after I actually had a few clients. When I was learning the industry, I saw what the accounts could do. It was cool. But when I actually sat down with some people and, I had people that would literally come and, you know, back when we used to meet in person, face to face across the dinner table, they would stand up and hug me and, literally just thank me so much for being that person that came out there and met with them and talked to them, because nobody had ever explained to them any of these financial concepts that are out there before. And then when you're sitting across the table and you have a little lady little old lady across the table from you crying because she's grateful that she feels like she can actually retire now, it changed everything in me. Like I was
No,
like, wow, like this is what we're doing is bigger than what I realized it was.
no, that's super dope, man. And I think I've experienced a lot of things like that, and it is exhilarating. It's and with the paycheck coming behind it, definitely is awesome. But that initial feeling
Yep,
is, it's addictive, man. Um,
definitely.
so in the industry, I know again, you got how many years of experience you have?
10 years now.
10. So you got 10 years of experience. And I know you've seen a lot of everything. What are some of the most common things that you see when you're dealing with clients as far as their financial situation?
One of the most common things I either see, probably one of the most common one, is that a lot of people are starting way too late.
Mm,
A lot of people are calling us and wanting to meet with us when they're 40 and 50 years old, and they should have started saving when as soon as they were, right out of college, if they had an income coming in, right? Or it should have been saving in their 20s. Should have been saving at 18, honestly. But a good place to start is definitely at your 20s. But that's one of the biggest things that I'll say that I see is people come in because they basically started too late. They thought that the government was going to be able to take care of them. They thought that, they hear the words the American dream, and in their minds they hear it and they just feel like somehow they're going to snap their fingers and poof, the American dream is going to be there and they're going to be able to retire. But then all of a sudden they get to a certain age and they're looking around in their accounts and they're like, where's this American dream that I thought was going to be there? I don't see anything. Like, maybe am I supposed to do this myself? Am I supposed And the answer is yes. You got to get out there and you got to make those decisions and start planning for yourself right now. And I don't want people to think that, if they wait till their 40s and 50s, oh, it's too late, don't do it at all. Because at least you're starting something. Starting something right now today is better than not starting anything at all.
No, I think that's a really great point. I was one of the points that we really drive home, especially in the Greatness Academy, is start early as you can. Um, I mean, time is important. Time is very important.
Yes, it is.
Um, so I think one of the other things that financial professionals bring to the table is the ability to educate other people. What's your favorite part of the education and why?
My favorite part of probably the educating people is the three rules of money. It's something simple, but it's something that's so simple that if people actually learn them and practice them, put into practice what they're learning, because knowledge isn't power until it's applied, then it can change their lives forever. And I like teaching things at a level to where I can go and talk to my kids, have the same conversation with somebody that's 30, 40, 50 years old, and everybody understands exactly what I just said after I got done talking to them.
No, that's good. I think, yeah, and I think you covered a little bit of it. I think one of the most important rules is that rule of 72.
Yep.
In combination with your age, that really teaches you how to, get some ROE on your money as soon as possible. And,
Hmm.
over time, it just compounds. Um, so let me ask you, you've 10 years in the game. What
Hmm.
is the craziest story that you have
On the client side,
on the client side?
Um, it's probably, let me think. That's a great question. Craziest story that I ever had. So, I was sat down with somebody that, to me, this was crazy because I sat down. I've grown up with this family, known them since I was probably 5, 6 years old. They've always had money. I never realized how much money they had until I got into this industry, and I finally felt confident enough to start having conversations and asking them, what's going on over there. And they basically told me, and they were like, you know what, we're probably doing, seven figures, multiple seven-figure range. And I was in the business for probably 2.5, 3 years before I ever called them because I was nervous, right? I was
Right,
scared. They're
right,
not gonna listen to me. They're good. They got somebody taking care of them. You can't have all this money, have this nice house, live this lifestyle, have all the new cars, and not be good,
right.
right? And I remember I sat down. Actually had somebody. It was so funny. I actually had somebody else in the office call them for me because I was so scared. I didn't want them to tell me no back then. And they called them. They set the appointment, and I was like, all right, whew, that's one thing. And then I went out there. Me and my one of my other colleagues went out there and sat down with them, and we sat down, went over so much stuff, and they were like, DJ, I'm so glad that you called me because we have been looking for somebody to take over our finances and help us out and give us some guidance because yeah, we make money, but we have nobody helping us, right? And they hadn't heard of any of the things that we talked about. I talked about the rule of 72. I talked about how money can grow. I talked about how money gets taxed, and they hadn't heard of any of those different things. And so after that, That's another thing that changed my confidence, is because I looked at them as like the top person tier of people that's out there that doesn't need any help. And after I went and talked to them and I realized that they need help, it didn't matter if somebody's making 500,000 a year, if they were making 750,000 a year, if they were making a million a year. In my mind, I know we can help them.
Oh yeah, absolutely.
Other families, if they needed the help that I know where they're at. I'm like, other people out there that anybody's making less than you, they need help, right? Even the people that are making more than you, they probably still need help. But anybody from, like I said, no matter what their income is now, it's changed a shift in my mind to where I was like, we're literally gonna change the world and we can help any and everybody out there.
No. So let me ask you, what are some of the things that some of the financial service products that you offer?
So we are a full service financial services firm. So it's not like it's just one or two different accounts out there. We help people out with old rollovers. Some people that have their money in a money market, they have old 401ks, old 403bs. Sometimes they even have money in pensions. With everything going on right now in the financial world, what people are looking at with the banks doing what they're doing right now, they're saying the next thing that could get hit are people's pensions, right? So the fact that we can roll people's pensions over into other asset protected class type products is a good feeling, because now if the pension goes bad and that person already rolls their money over, guess what? They rolled it over into something that was never going to take a hit and they're not going to lose any money. So we can do those, term insurance, we can do executive bonus plans. We've partnered up with attorneys. We can do wills and trusts for our clients. We also offer accounts like universal banks and IULs, which is really one of the most powerful products out there if it's structured properly. Right? If it's not structured properly, it's not going to be as good as what it could be, because sometimes people can get them and it just isn't structured right and it doesn't do what it's supposed to do. But if it's structured properly, it's one of the most powerful things out there in the industry right now.
No, that's really good, man. So I would tell you there's a lot of TikToking and
Hmm.
Facebooking, and I haven't even gotten to that portion of the TikToks and everything yet.
Right.
What are and as far as structuring a IUL correctly, like what
Yep.
are some suggestions you would give to the users to ensure, like, hey, if I'm not working with you, at least make sure the guy that's doing it is doing this.
Right. Right. So with an IUL, it's you have a wrapper of life insurance out there, kind of pretty much wrapped around your money. And what can happen inside of an IUL is basically what you're wanting to do is, there's a tax code out there, right? 7702A. And this is allowing you to pretty much, that's what a lot of people use to tax shelter their money, right? So they can put their money, they basically say you have to have this amount of insurance to put away, to put this much money inside of this account.
Got
So
it.
so sometimes what people will do is they say, hey, I want to put away 500 or $1,000, and $500 a month, right? 10,000 a year or whatever it is, 20,000 a year into one of these accounts. And depending on the agent can also look at that and basically say, oh, well, this can be a huge payday for myself, right? Yeah, I can help out the client a little bit, but I could really help my family out. And what you want to make sure is that the amount of money that you're putting in, the agent should be trying to pay for the least amount of insurance in that policy. That way, the cash grows how it's supposed to grow.
Got
But
it.
sometimes what happens, unfortunately, we live in a world where humans are humans, and sometimes the agent is not really looking out for the individual, and that agent can just be saying, okay, well, you could have, with this, $1,000 a month, could have gotten, a 300,000 or $500,000 policy, but it also can fund a $2 million policy. And I'm
Right.
gonna get paid more on the $2 million policy than the $300,000 policy. So we're gonna go with the 2 million. And if you don't know what to look for, you could be taken advantage of in those things.
No, that's good help, man. I think just I think the transparency in these type of accounts are key. I think another thing that people wonder about these accounts is how much, like, minimum, maximum
Mhm.
should you put in these types of accounts?
Right. And it kind of goes off of the age that you are. It also goes off of what your goals are in the future. If you're wanting to have access to this money sooner rather than later, you're going to want to try to max fund this account out. You're not really going to worry about the minimums because the minimums are not going to grow the cash value in it. The minimum is going to allow the account to stay going, and you're going to keep that coverage intact because you're paying the minimums, but you're not really going to see the big growth that a lot of people talk about. So I would normally say, and again, everybody's going to different. It's going to differentiate between the company and the person. It can even differentiate between the state that you live in, right? But I would say if you're, you know, upper teens, 18, 19, and the low 20s, you could be putting in, starting it off $50 to $100 a month, right? Once you start to get later 20s, I would say, hey, you should probably be doing anywhere from about 200, 250, right? You get into your 30s, now you got to start looking at saving, three, four, $500 a month. 40s and 50s, definitely you want to start putting in more because you have less time until you retire. You have less than 20 years, depending on what part you're at in the 40 range. So I would say, hey, you know what, maybe you should start putting in, 1,000, 1,500, maybe even more, and so forth and so on. I had a client that was in their 50s when they started. They're funding their account at about 30,000 a year, and literally in just 5 or 6 years, his numbers have already done exactly what we said they were going to do, if not a little bit more, but he's on track to get to his retirement age that he had and being able to be like live the life that he wants to live. He's on track to have his numbers where they wanted at retirement. And the best part about it all is when he's ready to retire, he's pulling out the money tax free, right?
No.
So it's not like he has the money and all of a sudden he has to pay taxes on it later on. He's already paid taxes up front, so he doesn't have to pay taxes on them later on.
Right. And I think you be having people eat, man. I love that. They
Yep.
be eating. Uh, yeah, I think you spoke of having the ability to understand where you are in life, and now looking at your rate of return, I see as you're getting older, you should be putting more money in. I think that's one of those things that we talked about, like with compounding interest. But if we look
Mhm.
at the like full spectrum, I think you kind of touched on each piece of it. Uh, can we talk about like how young can you start somebody in this account, and then what can that do for them in the future?
Yeah. Uh, I wish I had a chart in front of me so I could go exactly off of the numbers that I've seen on this one chart. But unfortunately I don't have that chart on me right now. But I know is the youngest that you can go is pretty much right around 2 weeks. As soon as the child has the social security number,
Wow, two
right?
weeks.
2 weeks, boom, you can get a baby one of these accounts, right? And you can start building it, putting money in their way for them. You can use it for a car for them when they turn 16. You can use it for college for them when they turn 18. You can use it to where you're just saving up for them and you're going to give them, just hand it over to them when they turn 30 for like a down payment on a home, or just like, hey, good luck to life. Here's what me and your, here's what your parents did for you when you were younger. And you can start it off that way. I did see one that we were funding, uh, we were putting in this account. I think it was about 250 to 500 a month for a child up until it started off at 5 up until about age 18. Didn't touch it again, right? Left it in that account, didn't touch it again. By the time the child was in their, I believe, 40s or 50s, they were already at seven figures in their
That's
account.
insane.
And this is at a conservative 6 to 7%
Yeah,
interest growth
that's
on
insane.
administration. Yep.
That's insane. And that's when he says conservative. We talk about on the program, like looking at 10 to 12%. That's kind of like, really what you want. Like year
Mhm.
in and year out, you want to look at about 10%, but at a 6%, 5, 6, 7% is a conservative amount that you should be looking at, especially at an older age, because you want to then get a rate of return being conservative, because we can't uh risk our money that way, because we're planning for retirement.
That's
um
right.
we talk about 7%, starting somebody young, getting 7 to 10% young. I
Mhm.
think that's just really the way to start building legacies, to be honest. That is the
Yep.
way to start building legacies. So I got a question, and I think somebody asked me the other day, and I know, but I couldn't get it out, and I thought this would be really good for the show.
Yep.
So first, let me start with this question, right? I'm moving from one job to another. I got uh a old 401k from my old job. What should I do with it?
So let me ask you a question. If you had a lot of money and you were in a relationship and you guys broke up, would you keep your money in that same bank account with your ex?
Oh no. Oh no.
Definitely not,
Oh
right?
no.
You definitely want to take that money out with you. So that's the first thing that I would suggest somebody to do is it's called a rollover, right? You would roll your money over from the account that it's in, the old 401k, the old 403b, or whatever it is with the old employer, and you can roll it into your own account uh, with all the companies that are available out there. There's a lot of different companies that are available. You normally have to go through, an agent, financial professional to get in contact with those companies, but you can roll it over into what we call an FIA, which is like a fixed index annuity, right? And when you do that, now you're putting your money, it's in the same tax category. It's normally considered a tax later category, but sometimes if it's with an old employer, it'll be a tax later category. Right, so you're rolling it over into this account, and now what's going to happen is when you roll it over, again, depending on the account, depending on the company, but I'm just speaking from my experience with the companies that I work with. Number one, what's going to happen is you're going to get guarantees on your money, right? You're going to end up getting rates of return of in those interest rates that me and Robert just talked about, right? It's going to be indexed as well. And index basically means that when the market is up, your money grows like the market's because the market's up. As soon as the market drops and goes down, there's a floor of 0%, and now you get 0%, right? You don't gain anything that year, but you also don't lose -10, -20%. You're just right there at zero. Then the market goes up again, your money goes up with it. So that's what indexing is. It just goes up and then over, up, flat, up, flat, up, flat, pretty much. So you get the index growth, and then the P is for pension income for life. So this is really important for people that are in their 50s and 60s because one of their biggest fears is outliving their money. Like, do I have enough money saved up for me to really go ahead and retire and stay retired? Right. So when they get the pension income, the company says, hey, based off of how much money you have, we're going to pay you this amount of money every single year until 75, live to 85, live to 95. We're paying you every single year until. And if anything, right, if you pass away before all this money's been paid out, guess what? It just goes to your beneficiary.
Oh man. That's
And on top of that, there's also a little special going on right now. Some of the companies that we work with are giving people a bonus, right? Some people are getting anywhere from a 10 all the way up to a 35% bonus right now,
based off of whatever they rolling over.
based off whatever they roll over. Yep.
So
So if they had $100,000 and they rolled it over into one of these accounts, depending on which company it was that we went with and which account it was that we went with, right? You could either have, if you got the 30% bonus, guess what? Day one, as soon as your money's in that account, you got 130,000 sitting there in your account.
yeah, and I think these are the hidden gems that I definitely want to bring to light. Um, and I know you explained it, uh, but I want to say I want to play a game. Let's play a game.
Yeah.
Like so, what you just explained is uh, kind of the not necessarily the structure, but what annuity is in a cleaner way to the audience. Can you explain to them what a new annuity is? Because you already explained what it can do for them, but
Mhm.
just kind of like in a clean way, explain how an annuity works.
So it's basically, and this is the thing, annuity can have a bad rep because of what annuities used to do
Right.
versus what they do now, right? Working in financial services, you're in an industry that's always evolving, so things are not always going to be the same, right? Annuities, when people first used to get them, what would happen is if you were to go ahead and what they would say annuitize, right? The person then they say they had $200,000 sitting in their account and they were ready to retire at 65. And they went in and they said, hey, we're going to annuitize this and we're going to have this pay out to us for the next 15, 20, 10 years. There's like a different time frame on the old annuities on which one you could do, right? And some were kind of unlimited, so you would just get a lesser percentage paid out to you every single year. But if you were to annuitize it and you were on the 20-year plan, and all of a sudden you get to year 10 and then you pass away, right? Now what happens is the family shows up and they say, "Hey, our parents had this account. They went ahead and annuitized it, but they had 10 years left, and we're here to collect the rest of that money." And what happened was those companies said, "Sorry, because this was your parents' account, and because they annuitized it, this money goes back to us because it didn't pay out to them. They were on this type of plan, so this one's not paying out to the family, right? But the new age ones that we have, right, and what annuities are, basically is when my clients have these accounts, they're not, number one, they're not annuitizing anything. They don't call the company and say, "Hey, I want to annuitize it," right? There is an income rider that's added to these accounts that automatically is going to pay them income every single year once they retire, right? You don't have to go through and do the whole annuitizing thing like you used to do.
Right.
So whenever they do the income rider and they start to take income, right? If they were to pass away and they still had 40,000, 50,000, 100,000, 2 million in the account that hadn't been paid out, guess what? It gets passed down to the family, and now the family is going to have now the family would receive that money that was in the account, and it's no longer of it being stuck with the company that it used to be stuck with, and just goes back to them, right? It goes to the family because they're the beneficiary, just like they wanted it to be done. So annuity is pretty much just like, insurance on your money.
Yep. That's oh man, that's it's killer. So uh oh, I didn't want to let this question get away. I know we get short on time, but definitely I did not want to let this question get away. How important is it to have a trust?
So this is what I tell people: if you own a house, if you're married, um, if you have property or anything like that, right? Even if you have children, you should get a trust
Period.
because those things, yeah, period. Because so many times we have the paperwork for it, but we never actually fill it out, sign it, answer all the questions, do what we're supposed to do, and then the good Lord comes and takes us home, and nothing was ever done, and now we're just basically not here to see what happens to our families, right? You got people coming out of the woodworks. Oh, by the way, your mom and dad, they said they were going to pay me this whenever, if anything were to ever happen to them. Oh, there's not a will. Good. Then I'm definitely going to contest this, right? There's so many different things are going to come out. Your cousin, like family can be all lovey dovey. And then all of a sudden somebody passes away. And then the sharks come out and they're like, "Nah, I want Uncle Jim's Rolex collection. He promised me that one day we were sitting on the back porch. He said I could have all that, or whatever that property down in South Beach. We always talked about going out there. He said that one's mine. Like so many different things can happen. So if you put those things inside of a trust, they cannot be touched, right? Because it's all protected from that. And if you were to get the trust, you would definitely put everything. The trust is going to own those things. You just name yourself as the trustee. Now, if anything happens, boom, you get to make those decisions based off the trust because the trust can't be sued anyways.
Right. And then you have your will built inside of the trust. So you already have your basically levels of instructions. And then I think listeners should really understand when he's talking about when people are, contest your property and things, those contests can last for years and
Years.
years, and so I think it's very important to, protect your family, protect your assets, get a trust. Hey, so how can the people get a hold of you? I know after watching this, it's going to be some people wanting to reach out. Some
Yep.
people want some more information. People want some education on the things you do. Uh, how can they reach you, and how much does it cost?
So anybody, I mean, people can text me. They can send me a message on social media. I'm on Facebook, DJ Patterson, but don't forget the dots in between the D and the J. So D.J. Patterson the second. On Instagram, it's just Patterson II. But if they wanted to reach out to me directly, they can reach out to me by phone number 615-869-9535 and just shoot me a message. Just, put in there, I heard you on the podcast. I have a couple questions and I don't mind answering any questions. And I'm glad you asked about how much does it cost because typically most financial services companies and people that work there charge people anywhere from $500 to $2,500 to sit down and have a conversation with them. One of our biggest things is that we're actually focused on helping as many people out there, right? We focus on people that are in middle America, but we don't have any minimums or maximums. So I don't care if my client is making 3,000 a month or they're making 3 billion a year. I can help anybody out there. But when somebody comes to me and we sit down and talk, I don't charge anything. right? I just want to have a conversation. I'll sit down with them, and we do everything for free.
Man, that's awesome. Hey, thank you again for joining us so much. On the program, we always say winners win. And when I win, we win. And when you win, we win. And
Sir.
I really appreciate you for being a winner, man. And thank you for inviting me into this world. I've been able to, take off since you pulled me in, and I'm still grinding. And I really appreciate you for showing me this education, man.
Yeah, man, no problem. I appreciate you having me on. Let's go out there. Let's all go win some more.
That's it.